philosophers and economists have pondered since the beginning of time, and that would be, am I wearing pants? And the answer is no. Just kidding. Instead, it's whether or not we could finally see the market begin to recover in 2023, or if it will continue falling with the worst still yet to come. After all, retail investors are officially buying the dip, with some analysts believing that we could soon be in for another 2023 bull market, while others like Goldman Sachs take the stance that we'll continue seeing a market crash, stocks are still not cheap by historical standards, and will likely fall back down another 20%. That's why I think it's incredibly important that we go over the data to determine whether or not there's an accurate way of predicting the bottom of the market. Here are the bull and bear cases for determining whether or not 2023 is going to be a winner or a loser, and then go over the best ways that you could use all of this information to make money on this episode of Don't Drive in the HOV Lane with an Inflatable Grinch, in case you were wondering. Although before we start, if you enjoy these videos and you find them helpful, it would mean a lot to me if you hit the like button or subscribed if you haven't done that already. I know it sounds silly, but it does help with the channel tremendously, and as a thank you for doing that, here's a picture of a giraffe. So thank you guys so much, and also a big thank you to Public.com for sponsoring this video, but more on that later. Alright, so in terms of why the market keeps falling, blame Jerome Powell. No, seriously. For the last year, the vast majority of stocks have decreased anywhere from 15 to 80% due to an increase in interest rates and a strategy called quantitative tightening, where the Federal Reserve begins to sell or remove assets from their balance sheet, causing prices to fall and rates to increase. See, prior to 2020, anytime a company needed money or a bank wanted to issue a loan, they'd have to rely on institutional investors who would only bid an amount that was relative to the risk that they would lose money. But when everything shut down and those investors were cowering in the corner while grasping onto whatever cash they had left, the Federal Reserve stepped in to backstop those investors and buy up whatever assets were being offered just to prove to the market that everything was going to be okay. Obviously, that strategy worked, but the Fed is not in the business of building a portfolio the size of Wall Street bets, so eventually they had to sell. But now that the Fed is no longer an active buyer in the market, that leaves it up to investors to decide how much they're willing to pay. And with risk-free interest rates now around 4.5%, those investors are demanding a premium for investing in anything that's slightly more risky, and in turn, stocks and real estate look a lot less appealing. Just think of it this way. What if I told you that you would be able to get a risk-free guaranteed return of 6%, or you could take your chances in the stock market for a maybe average of 7%. What would you pick? Now, it's never a directly proportional relationship, but the math is generally true. The higher you make risk-free, the more you have to get paid to take on risk. And as proof, just consider this. I've mentioned this before, but it's worth repeating. One study analyzed investor behavior when risk-free returns were low and compared those to the same investors when risk-free returns were high. And the results were surprising. It was found that throughout a representation of the entire US population, as well as 400 Harvard MBA students, low risk-free returns caused significantly more risk-taking for higher-yielding investments. Those findings began to normalize when risk-free interest rates are higher, even when the riskier investments still pay the same amount more. Now, I know that sounds incredibly confusing, but for all of you visual learners out there, this basically means that when interest rates are at 0%, 70% of a customer's portfolio went into risky investments, driving up their price. But when risk-free interest rates are at 5%, their risky investments dwindle back down to 50%, reflecting a more balanced portfolio. On top of that, they also found diminishing returns on safe behavior once interest rates were above 5%. So the most risk-taking takes place when interest rates are below that amount, which very accurately reflects these last few years. Based on this information, we might be able to conclude that the worst would be behind us once risk-free interest rates are above 5%, although we'll talk about that shortly. But in terms of how you could identify the bottom of the market, or whether or not you'd be able to outperform it, there's a piece of research I want to comment on, because this begins to make a lot of sense. Now, first of all, I want to give full credit to the blog Market Sentiment for compiling all this information. I would highly recommend subscribing to the newsletter. I'll link to them down below in the description, because they compile some of the most interesting investment analysis on the internet. And their latest findings all have to do with learning how to beat the market. See, as they point out, passive index fund investing is relatively new. So new, in fact, that 2019 was the first year ever where index funds overtook actively managed funds in terms of assets under management. So why is this a big deal? Well, two things happened. First, the great financial crisis of 2009 shook a lot of investor confidence and caused a lot of people to be wary of the investment industry. And two, there was a substantial pile of data showing just how poorly actively managed funds performed. For example, they say that only 6% of actively managed large cap funds managed to beat the S&P 500 over over a 20-year period. So the option then becomes, do you take a 1 in 16 chance of getting a higher return, or